All right, really important video. We just had FedEx and Nike report earnings. FedEx is the backbone of our economy, right? Their report tells us all kinds of stuff we need to know about how healthy the economy is and what they're seeing moving forward. And then Nike is the health of the consumer, right? They are a strong brand, a strong relationship with a more upper end consumer. So we're gonna find out a lot about the economy and the future of the market by going through these two reports. At the end of the video, I'll show you my current portfolio and any changes I've made recently, so stick around all the way to the end. All right, first up, FedEx. You can see FedEx was down today and it's up post-market. Thing number one about investing, don't make any crazy decisions after market trading. That's not what long-term investors do, okay? So let's just settle down. But FedEx beat on the bottom line estimates, but they offered a weak guide into 2023. So we're seeing a weakening economy into 2023 from FedEx, which is a company that sees a ton of data about the health of the economy. They had a surprise beat on the bottom line, which means earnings per share. That can be good and bad. It's not necessarily showing strength in the company. It's just showing that they might be doing some cost cutting to get more efficient, which is a good thing, but it may not mean that they're seeing really strong results. They posted $3.18 in earnings per share for fiscal second quarter on $22.8 billion in revenue. Consensus estimates for revenue or for earnings were 283, so they beat that, but revenue was 23.72 billion. So we saw them do better in earnings per share than expected, but worse in revenue than expected. Lower global volumes for the express business was cited as a particular headwind for the company, offsetting some of the cost-saving initiatives pursued by the company. So that's exactly what they did. They were able to, save more money, but they weren't able to push more sales. The FedEx team moved with urgency to make rapid progress on our ongoing transformation while navigating a weaker demand environment. Our earnings exceeded expectations second quarter, driven by the execution and acceleration of our aggressive cost reduction plans. Company expects to garner $1 billion in cost savings beyond its September forecast, totaling $3.7 billion in savings compared to its initial fiscal year 2023 business plan. Capital expenditure expectations for the full year were also reined in at $5.9 billion from $6.3 billion. So they're cutting down capital expenditures, okay? And this is good for FedEx that they're getting more efficient, but we're going to see more and more of this from companies as they report, and that means there's just going to be weaker demand all around for different things in the economy, which could be great to help fight inflation, but we are almost certainly going into some type of recession in 2023. Doesn't mean it's the end of the world, though. Okay, so this is Stock Unlock. I'm a paying user. This is not an advertisement. It is one of the simplest, most user-friendly research sites that I've seen. It's also really affordable, too. A quick kind of cheat code to tell just if a company is potentially a worthwhile investment, if it's not in a hyper-growth type of stage, is looking at its free cash flow yield and its earnings yield. Right now, I think the 3-year treasury yield is at around 4%. But if you see the free cash flow yield above the treasury yield of around 4%, then that means you might have a little bit of margin of safety. It may be worthwhile to dive deeper into a company. And so we could see FedEx's free cash flow yield is 6.55% and their earnings yield is 8.17%. Okay, and right here we can see analyst price targets, right? And we take these with a grain of salt, but still it gives us an idea of how analysts are thinking about this company. And these are for December 2023. You've got a high price target of 270, which is up almost 65%. The middle or the average is 196, which is about a 20% gain. That would be great over a year. And then low is 126, which is a 23% drop. And we'll have to do an update on this video when their new projections come in. But analysts were expecting earnings per share growth of about 13% for the next year. And then looking forward, the dividend is what will attract a lot of people to FedEx, right? The forward dividend yield is 2.7%, which is above its 5-year average of 1.4%. This can oftentimes mean a stock is undervalued or is a good buy, but sometimes there's a reason the stock price is down, which pushes the dividend higher. And so we have to look in if we see it as showing undervalued. We can't just assume because the dividend's higher than normal, it's a great buy. They are increasing the dividend, which is great. The 5-year dividend per share is up 18%. The payout ratio is only 33%, and then the free cash flow payout ratio is 42%. So both of those are pretty healthy. But the free cash flow payout ratio is increasing, and so that's something we have to keep an eye on. Okay, so we do want to keep an eye kind of on the financial health or the debt levels of FedEx and really any company. Their current ratios really just compares a company's current assets to its liabilities. We see the current ratio at 1.4. We definitely want to see that stay above 1. They are buying back shares. Looks like they slightly bought back shares over the last year, which is good to see. We're seeing some slight increases in revenue, gross profit, and operating income. Net income did decrease, so we want to keep an eye on this. And then operating cash flow is also decreasing, something we also want to keep an eye on. Gross margin comes in at about 68%, operating margin of just under 7%, free cash flow margin of 3%. And finally, the PE is showing as 12.2, which is well below its 5-year average of 49, but that's way too high. It's thrown off. So we should actually look at it on a price to free cash flow or even a price to sales level just to get a better kind of picture. And you can see it's actually showing as, below its 5-year price to free cash flow level. It's currently at 15 and the 5-year level is 29, but then price to sales, it's at 0.5, which is below its 5-year average of 0.7. Price to sales, not a great way to evaluate FedEx's stock, but if we're looking at it compared to its historical price to sales ratio, then it is a decent metric to look at to see how it's doing on a sales-related basis. For earnings, another great way to look at it is the forward price to earnings growth ratio. If this is 1, that means that the PE is exactly what the earnings growth rate is expected to be. So if you have a PE of 12, earnings growth rate is 12%, your PEG would be 1. And so it's actually just under 1. Anything under 1 on a price to earnings growth ratio could signal that the stock is undervalued. All right, moving on to Nike. And wow, Nike is bouncing after hours, up 9% after hours. This was just a strong report all around. GAAP earnings per share was 85 cents, which beat by 21 cents. Revenue was 13.3 billion. That beat by 740 million. So just strength all around, right? Direct sales were 5.4 billion, up 16%. Nike has been doing so great in their move to direct sales, which is where they sell it, through their website or their own stores or whatever, versus through another third party or a retailer. Brand digital sales increased 25%. Wholesale revenues grew 19%. Gross margin decreased 300 basis points to 42.9%. So something to keep an eye on there. That means that they are likely having to discount items to push sales through. That's okay, but we definitely just want to keep an eye on it. Inventories is another thing to keep an eye on. 9.3 billion, up 43% compared to the prior year, driven by an increase in units from lapping prior year supply chain disruption. Okay, so as well as higher input costs. Okay, and Nike is quickly becoming a share repurchase and dividend growth story, right? Cash and short-term investments were 10.6 billion, down 4.5 billion from last year, as free cash flow was offset by share repurchases and dividends. They returned $2.1 billion to shareholders, including dividends of 480 million, up 10%. Share repurchase of 1.6 billion, reflecting 16.5 million retired shares. They have a 4-year, 18 billion program that's been approved by the directors in June of 2022. And wow, we can see those shares bouncing. Okay, same thing. We're going to take a look at Nike. Nike is not as attractive on a free cash flow yield or earnings yield as FedEx, but something like this, a free cash flow yield around 2%, earnings yield around 3.5%. If you believe in the growth story, then you would be willing to pay that, right? Now, this is a great report. Nike's up, but I have some concerns that's keeping me from investing in the company or starting a position now, right? So earnings per share growth is expected to slow down, but it's trading at a PE of 28, and it's actually trading at a forward PE because of that earnings growth shrinking, a forward PE of 33. So this stock is pretty pricey in my opinion, but again, you have a very safe balance sheet, a very reputable brand. They have a moat, they have pricing power, they have direct sales. They're a cash churning machine. They're repurchasing shares, paying a dividend. So there's a lot to like about this stock, but I do think it's a little bit overvalued. I like the companies that I own in my own portfolio, and so if this thing comes down, I'll definitely think about starting a position. But right now, I'm not going to be starting a position in Nike or FedEx. Okay, they have grown the dividend at 11% on average over the last 5 years, which is great. Payout ratio is low, so they've got room to continue, paying their dividend or growing it over time. Obviously, very strong financially. Current ratio is 2.6. They are buying back shares like we talked about. Plenty of cash. But again, this growth story, in my opinion, there's a lot of questions here. So I think we could see the multiple come down, the price to earnings multiple come down a little bit. We'll see. I might be wrong. And if so, that's okay. Returns on investment are just fantastic for this company. Gross margin about 45%, operating margin of 13%. And so if somebody owns Nike, I totally understand it. I totally get it. It's great for dividend growth. Just not a stock that I plan to buy right now, but one I would love to own. If you're enjoying this content, do me a favor, like the video. That helps more people find it, and then subscribe to the channel. I do all kinds of videos. This is what I've been buying recently. Bam, Brookfield Asset Management. And I just did a video why I bought $5,000, so check that video out. And like I said, I always share my portfolio here. I have a $115,000 portfolio. We were up $810 today, which is great, but don't get too excited, Austin. You're still down $23,000 since February 15th, 2022, which is when I started this portfolio. But I'm a long-term growth investor. I'm going to continue buying shares of what I think are fantastic companies, and I want to build a really great portfolio over 5, 10, 15, and 20 years. Here's the stocks I own. I haven't made any changes if you've been watching this channel. The only thing I have done is bought about $5,400 or whatever, $5,000 worth of Brookfield Asset Management. And so we've got 184 shares, 27.15 average share price, and stocks up to 29.36. And so, hey, that feels good when everything else that I own is just completely down over time. Anyways, thanks for watching. We'll see you tomorrow. Make sure you come back.